Hi guys, this is Ravi again from the NiftyBees channel, and today we are going to discuss about an interesting income strategy which lets you make both weekly and monthly income. So the question is how to generate income on the Nifty 50 index. Do you know that there is a way you can earn consistent weekly or monthly income by investing on the Nifty 50 index? The answer would be yes. But Nifty 50 is an index and not a stock. So how do you invest in it? This can be done by buying 7500 units of NiftyBees, one unit of which at the time of making this video is trading at 95.38, and then selling an out of the money call option each week or each month. So how is this done? You would need about rupees 7,20,000 to buy the Nifty Bees and then about rupees 1 lakh as margin money to write the weekly or monthly out of the money call option, which makes this somewhat an expensive strategy. So why invest in Nifty Bees or any other Nifty 50 ETF? A single stock, for example IndusInd Bank, is subject to far greater share price moves than, say, an ETF that tracks the 50 large company stocks in the Nifty 50 index. You are actually investing in 50 large company stocks rather than investing in just one stock. Also, one can expect some intervention from the government and the RBI whenever the Nifty 50 index underperforms. Before getting into the details of the strategy, let's know what is NiftyBees. NiftyBees is an ETF, exchange traded fund, from Nippon Life India Asset Management Limited, also known as NAM India. NiftyBees has the Nifty 50 index as its underlying asset. There are other ETFs available too, like the BankBees that has the Bank Nifty index as its underlying asset, and the GoldBees that has the gold commodity as its underlying asset. But what is an ETF? Equity exchange traded funds, known as ETFs, are flexible, simple, transparent, and easy to trade investment products. They have a very low upfront cost. Let's look at some advantages of ETFs. They can be bought and sold continuously at market prices like any other company stock. They mirror the index and hence offer better transparency into their holdings than competing mutual funds. Another advantage over mutual funds is that they have much lower expense ratios. Expense ratios can be considered as annual maintenance charges. So, which Nifty ETF is better? There are 10 plus ETFs on Nifty 50 available for investment in India. With so many ETFs around on Nifty 50, how do you decide which one is the best for you? The main consideration should be liquidity. An instrument is considered to be liquid if there are enough buyers and sellers with good volumes of shares. The spread between the offer and bid prices, also known as the bid-ask spread, should be smaller. So the key here is liquidity. Liquidity is hugely important as you need it in good measure to get in and out of a stock easily. You need to have high daily volumes, as if there are not enough buyers and sellers, it would make it difficult to enter and exit the trade at the right level. Low liquidity means there is a wide spread between the offer and bid prices. This is where the Nifty Bees scores over others. Now let's look at a practical comparison between Nifty Bees and SETF NIF 50, by far the most traded ETFs. In the above snapshot, you can clearly see that there is a good volume in Nifty Bees, and it also has a bid offer spread of less than 10 paisa, which is considered good. Whereas there is just enough volume in SETF NIF 50 and the bid offer spread too is a bit wide, more than 10 paisa. Now let's get back to the strategy. Let's look at how an income strategy can be built around the Nifty Bees. As has been mentioned earlier, you would need 7500 units of Nifty Bees to consider this strategy. And then a weekly or monthly out of the money call option needs to be shorted. This can also be seen as a covered call strategy on the Nifty 50 index. One way to determine which call option to write is by making use of the at the money straddle price. Now let's look at an example and get familiar with the calculations involved. Since we are already halfway into the month, and since this is also a weekly expiry day, let's see how a weekly option strike price which is to be sold can be determined. The Nifty is currently trading at 9,000. So the ATM straddle price would be 9,000 put option premium plus 9,000 call option premium. Both options are of the same April 23rd expiry, which comes to about 400 by rounding off to the nearest 100. The out of the money call option strike price can then be determined by adding the Nifty spot price to the ATM straddle price, which comes to 9,400. So an out of the money 23rd April 9400 call option can be sold for the upcoming week and the premium collected, which is about 66. If by 23rd April Nifty stays at or below 9400, the premium, which translates to about 4950, would be yours to keep, and if it goes beyond the break even point, which is 9466, you can close the trade. That is, buy to close the sold 9400 call and sell to close the 7500 units of NiftyBees. This translates to a handsome profit. Similarly, a monthly call option can be calculated and sold on the last day of April expiry, that is April 30th, using the same ATM straddle price method. Thank you for watching. Please post any questions you have on this video in the comment section.